Ladies and gentlemen, welcome back to the Daily Capital Flows live stream. Is it Wednesday? It is Wednesday. We've already had 2 live streams this past week breaking down the thesis that we have around PER. James just finished a video breaking down Oracle. I think it's one of the best descriptions of why Wall Street doesn't want to bet against, why it wants to bet against Oracle right now, and why it's completely offsides. And we're going to cover the global macro regime today, talk about Oracle a little bit. And what I really wanted to do in today's session is take the time to be able to zoom out a bit and talk about the largest driver in markets, which is macro, and the changes in interest rates that frame the situation for macro. And the reason for that is over the last several weeks, we've talked about very specific theses for the asymmetric bets that we are taking. And it would, miss the bigger picture and misdiagnose the drivers and why we even came up with those bets in the first place if you don't understand the macro regime and why it is framing the push out the risk curve in the credit cycle right now that capital is chasing, and it has to chase on a fundamental basis. And so we're going to be covering all of that with interest rates, FX. There's some other things on SpaceX, also some equity dispersion that I want to cover that will be incredibly important. But, James, maybe you can start from your perspective on how it's very easy. We've just had a 200% rally in PER from the lows. We've had a pretty significant rally in Oracle. We've been laying out these bets for a while, and it's easy for someone who maybe this is their first time having a big gain or first time watching this in real time, or maybe they just kind of came on the stage more recently and they don't understand why macro matters, why the context matters. Maybe you can kind of explain a little bit on how you think about that as the necessary frame of reference for everything that we're doing.
Yeah, that's a really good question. I don't know if I've ever really been able to best put that in words, but I think through working with you over a bunch of years now, it's like I've come to the realization that like any moves could happen, right? Anything could go up, go down in the short term, and there could be all this positioning on even positioning unwinding, right? Like it could convince you that bigger things have changed. But I guess I've switched now to this idea of thinking okay, even if I want to arrive at a bet like PER or something like that, I need to better understand how the ocean floor is moving, and then how is the ocean surface moving, right? If I could better understand the ocean floor and the rip currents underneath and what's actually controlling the motion, I could start working my way up to the surface and understand better as to why things are happening up top. And I think if you're not doing that, you're going to come into you're going to maybe this is the first stream you're watching and you saw PER go up, you saw the thesis on the gamma squeeze, you saw the Oracle video, and you're like, I'm going to tune in and figure out why all this stuff is up and where can I enter, where whatever. Well, if you've there's some people who have been here every single stream we've been doing. They've laid a foundation to understanding exactly why we're in these trades, why we're holding them, why we're maybe we're going to enter, exit in different fashions eventually. But they understand the undercurrent as to why we think they're the most asymmetric bets available to people right now. And so myself, I'm trying to always remember where we came from, essentially, right? Remember why, or try to understand kind of what is the macro regime we're in? Is liquidity expanding or contracting? Are rates globally restrictive or unrestrictive? If so, then let's move up to the next level of the ocean. Okay, what asset classes are moving the most and in what direction? And then within those asset classes, the subsector. And within the subsector, the individual asset. And then what is the best trade expression of that individual asset? And then chart wise, should I be entering here or exiting here? How does that fit into my portfolio? And that's how I've kind of like ground up, worked my way into the capital flows ecosystem. And that's just how I do it. So I suggest you guys, if you are newer here, to do that, run through that system yourself. Go watch the last, take this week and just grind on 2x speed the last month of live streams, and you will be caught up to date as to like why we are here now. Because if you look at the PER price today, it's like down 4%. And you might be asking, what's going on with PER? Like I thought this short squeeze that, like you'll understand and have a better baseline of like how we're looking at things and be able to clearly start asking better questions. That's me. And by the way, before I go back, toss it back over to you guys, if you did show up here, if you have been enjoying this stuff, please on X, it really helps us. Like go retweet it, comment it, like on it, so do something to get the word out better. We want to become one of the better educational experiences for people that are providing.
No, we want to become the best educational experience for people in financial markets as it relates to macro and asymmetric bets. We will become that. So if you guys want to come along for the ride, welcome to the team.
Welcome to the team. T-shirts are on their way.
We are trying to get merch. We are trying to get merch.
It's harder than you think. Like I've tried to, guys, I want a quarter zip. Like I want a blacked out Pepe quarter zip. I'm working on it. I want a team gear, so it's not easy. If anybody out there has like a really high quality dialed in custom merch type of situation, hit me up, because the stuff that hits you in the face from being marketed to you is not good quality. So we're going to be careful. Just like everything, we're going to find a way to make it good. So
I love it. Let's also, James, what size is that monitor? It's taking up the majority of your entire room right there.
Well, it's just a fisheye lens. Come on, guys. You know how cameras work. It's the same size as that monitor back there. It's a 49-inch curved Samsung, and if you aren't rocking these, I think Capital Flows is rocking these.
I have two of them.
It's a game changer. They're not that expensive. Invest in your setup. Like I work for myself. I want to walk in here every day. I got my walking pad. I got my 2 curves. I feel pumped and ready to go every single day. Get off your shitty old laptop on your couch and step it up.
I would still be on my laptop on my couch if it wasn't for James. So props to him. He's gonna
couch, bro? What couch?
It's true. Okay, hey, there was a period of time. But I still refuse to walk on a treadmill. I'm just like, why don't you just go outside and go for a walk? Why don't you just go for a run? But let's not put anything too difficult on you, James. Like,
hey, I also go outside and walk every day. I'm doing 2-a-day walks here, buddy.
It's literally easier for you because you're taller. It's like walking is literally easier. You have a
problem. Like if I take too big of steps, I get into the wrong neighborhood. You know what I mean? You could walk around a track and 1 lap will take you an hour. So it's easy for you to say.
It's true. All right.
I'm just imagining the little Pepe just like walking around the track. Yeah, just little tiny steps in a hoodie.
I am probably as tall as like a little Pepe right now. Yeah. So it's what our Pepe. It's actually funny on AI. If you're trying to create a Pepe, they're usually like shorter, right? They're like looks like a 4-foot little little midget, and you're like, oh, that's cute. It's like the little minions, You're like, oh, like the little
minions.
Yeah. So
somebody go out there. Yeah, get serious. But somebody go out there and make a Minions Pepe meme, with the little Minions glasses and stuff. And if nobody does it, I'll do it. It'll be great.
There you go. I like it. All right. Let me pull this up. As a starting point, I want to remind everyone, every single thing is laid out on the Substack. So if you go to capitalflowsresearch.com, you will see every single thing laid out on the website. You need to go through One, all the live streams. All the live streams are recorded every single day on the YouTube channel. So you can go, they're always linked on the YouTube channel. They're also on my Twitter page. Like, you guys know how to find them and everything like that. On the most recent article that I published, I've pulled together all the views. So if you're just coming in and you're saying, I'm trying to understand the context of everything, go to the article I published on May 30th. Don't really expect to have a really exceptional view of markets if you can't take the time to go through this one article. It's all free. It's all broken down. And I laid out the big picture for PER. I laid out all the credit cycle links. So here's all the links for the credit cycle, all of the articles I published on PER, and then all the articles I published on Oracle and AI. Throughout all of these articles, I always give you guys models. So basically, my goal is I want to give you every single thing that you need to be successful. So your biggest limiting factor is you. And then that's entirely in your control. And then it's all about, do you want to commit? And you can't really complain like, well, I didn't have all the resources, the education or whatever. Like if you're complaining that you don't have the education and resources, you are totally missing the picture. And so on the website right here, you can even go to the Hyperliquid Global Flows article published on May 26th. And there's an entire Hyperliquid model down here at the bottom to map the funding rate dashboard. Even if you're not a Hyperliquid person, right? I mean, I don't know if we're going to be trading or on Hyper or, trading Hyper or, I think Hyperliquid is going to be around, years in the future. I don't know if I'm going to be trading Hyperliquid or long Hyperliquid in a year, 2 years, 3 years, 5 years. I don't know. I hold winners until the thesis begins to deteriorate. Or the thesis still remains intact, but I think that it's all priced in. And so I'm always trying to find the most asymmetric bet. Even if that is the case, understanding Hyperliquid is going to help you understand every other part of finance. So you want to really begin to disconnect, anything that we share on this live stream and any of the tools that I share on the Substack are going to be instructive for all of finance. So if you go through the Hyperliquid funding dashboard, you're only going to understand better how futures rolls work, how funding rates work, how margin works. Once you begin to realize how leverage in the system functions, you are going to understand why there is buying and selling pressure in the equity market. Because a lot of people that are trading in the equity market think that, well, the equity market, when it moves around, it's all people like Buffett who never use leverage. That's not really the case. When you look at all of these changes in financial markets, when we look at the S&P 500, all of these moves, sure, there's long-term holders that buy, that buy whatever amount of, stock, but the majority of players in the market, myself and James included, we trade with a lot of leverage because leverage is meant to help you exponentially amplify, one, your specialized knowledge of markets. And actually, it is actually there, if you do it right, to help you take less risk, not more. And so that is one of the things that's really key. I think that people still don't understand that, a lot of times when you put on a certain trade, if you are using leverage, you can actually have, multiple positions sized against each other, correlation adjusted. And you can say, I want to be long stocks and short bonds, or long stocks and long bonds. Well, you need to be able to put up leverage to put those trades on. And that allows greater efficiency in the market. So whether you want to use leverage or not, I'm not, saying that everyone should use leverage or anything like that. What I'm saying is that there is a fact in markets that the majority of players use significant leverage, which means that if you don't understand how the supply and demand of leverage work via interest rates, then you will not understand the constraints that are going to cause those individuals to buy and sell. And so what I wanted to cover today is the entire picture for interest rates, how it connects to the bigger picture market. And everything for me always starts with interest rates. And the reason for that is because they're the price of money. If you want to know how much liquidity is in the system, the most significant input into that equation is interest rates. And so people who say they have a view of macro liquidity, they're a macro liquidity index, but they don't have a view on interest rates, by definition, they don't have a view on macro liquidity. It's impossible. Macro liquidity is defined by interest rates. And that's why, if you've been following me for any period of time, actually we talked about this on the live stream yesterday with Skew. The macro liquidity picture that I lay out every single day is based on how does this connect to price action. A lot of people are sharing all these indices or models now with M2 or reserves or the TGA and the Fed balance sheet, and they put an oscillator on it. And there is zero connection to the actual price action of things. And so, the goal that I have is to really share those mechanisms more and explain to you why behind that. And so we're going to start with the Capital Flows Research dashboard that I have. This is the dashboard that I've built out for every single strategy that I have, how it functions, how it connects into the macro picture. And what you will see here on the left-hand side is everything starts with the interest rate pricing of the forward curve. So right here, you have where the current effective Fed funds rate is at 3.62%. So the Fed has set rates at 3.6%, and terminal rate is at 4. So simply put, the market is saying we're at 3.6. We're going to have basically 40 bips of hikes, and then after that, we're going to move back down. And if you look, right now, the Z6 contract, we'll just go to the Z6 contract, is right now pricing 27 bips of hikes for this year. And so what that means, let me pull this up, is Z6 is about how many hikes or cuts we're going to have between now and December of 2026. Z6 just represents 26. And you can see that right here, you have the lines that show on the SOFR contract, and you can pull this up on yourself. There's actually this exact model is on the website. You can download it yourself in the model section of Capital Flows Research. So if you go to the main page, go down to the educational primer section right here, scroll all the way down. In these models, you can get this exact model that I'm sharing right now. And so on the dashboard, you can see that we have moved up in interest rate expectations. This is how we quantify what the actions of the Fed are likely to be, or what the market is pricing them likely to be. And then we can say, okay, well, how does that connect to the changes in the broader market? So notice right here, you have had the forward curve for 2026 price more rate hikes. So we went from pricing rate cuts, 50 bips of cuts, to pricing no cuts, and then pricing 25 bips of cuts. We came back down, and we've been grinding up since then. Now notice that we have moved up in interest rate pricing for this year, which means that we have priced higher interest rate, more restrictive interest rates. So when interest rates rise, think about this in the same way that you have a mortgage rate on your house. If your mortgage rate rises, that could make buying a house less affordable. And most people think about the mortgage idea as it relates to their own situation. But what you want to recognize is that every single player in the economy uses debt. And when interest rates rise or fall, that fundamentally changes their ability to take out debt. So for example, if I'm borrowing money to trade stocks, or if I'm borrowing money to fund my business in the AI space, in the industrial space, in the utility space, in consumer discretionary, in a grocery store, whatever it might be, if I'm using debt to do that, which, newsflash, every single company does that in the world. There is only a select few of companies in the world that don't have debt on their balance sheet. And even if they don't have debt on their balance sheet, implicitly in how they're cross-collateralized with their suppliers and the consumers of their goods or services, they have sensitivity and exposure to debt via proxy and how they're cross-collateralized with other companies that do have debt. And so the idea is that these changes in interest rates reverberate across the curve. Now, what we need to say is, okay, interest rates are important to understand as it relates to these SOFR contracts. SOFR contracts are just pricing what is the Fed going to do in 2026, 2027, 2028, 2029, 2030. And across all of these contracts represent how the market is pricing actions by the Federal Reserve. So each of these contracts have to settle at whatever the Fed is going to do. Now what we need to ask is, okay, the Fed right now, the market is pricing higher interest rates across this year. So basically a hike this year and a hike into the M7 contract, which is in 2027, basically beginning of 2020, middle of 2027, M7. And you will notice that this is what we would call terminal rate. It is the highest point on the curve. So it is the market pricing higher and higher interest rates through the M7 contract. And then once you get there, the market says, okay, and then after those hikes, we're going to cut. So if the market is pricing, let's say 40 bips of hikes over the next year and a half, what we need to ask is that expectation by the market, is that realistic for one, what the Fed is going to do? And is it restrictive enough relative to the growth and inflation in the system? That's where we begin to look at inflation swaps. And you will notice that the changes in inflation swaps matter a lot because when we go to inflation swaps, we can see, let me pull this up right here. You can see that we have been moving down in inflation swaps as we came into the beginning of 2026. As we moved to 2026, inflation swaps began to rally and move up, pricing greater inflation risk. And this is all about, okay, is the Fed restrictive enough relative to inflation? So if inflation is running at 10% and interest rates are at 5%, then it's clear that the Fed is not restrictive enough, right? You basically want interest rates to be around where inflation and nominal GDP are at. So if you have interest rates at directly where, and again, this kind of gets into some theoretical concepts, and there's going to be a bunch of guys that have a bunch of like arbitrary views about, well, what is neutral? What's this? What's that? At the end of the day, if you're trading markets, none of this stuff is complicated. All it is you're always looking at is the changes in interest rates relative to inflation swaps restrictive or not restrictive. And what we can see right now is inflation swaps still remain elevated. So we have inflation risk in the system running at 3%. When we have 2-year inflation swaps, they're actually even more elevated. 5-year inflation swaps, they're elevated as well. And then 10-year inflation swaps and 30-year inflation swaps, they're a little bit lower. So we have an interesting shape of the inflation swap curve. But fundamentally, we have a higher degree of inflation risk right now that the Fed is pausing into. So the main driver behind that are the changes in crude prices that have remained elevated. Now, the question you want to ask here is, these moves in crude, these higher inflation levels in crude, is that going to seep into the rest of the economy? And we're not seeing it be too significant yet, but it is on a marginal basis because it's remaining elevated. If crude prices would have just dropped back down already to this level, we probably would have, long-term interest rates find a better kind of top, and they would not be at risk to move up right here. My view is, and I've laid this out multiple times, is that, interest rates at best on the long end are neutral. And at best, they're neutral, and they're likely to just tick up marginally. 10-year rates are probably going to tick up a bit. And you're saying, why is that? Why is it that 10-year interest rates could tick up a bit? One is that inflation on the short end remains elevated. Number two is we want to say, okay, inflation is elevated, and the Fed relative to that inflation is not being incredibly restrictive. So real interest rates map the relationship between how aggressive is the Fed. So if inflation goes up, let's say inflation risk increases by 100 basis points, by 1%. And then the Fed says, oh, you know what? we don't like that inflation risk just moved up 1%. But we're only going to move our expectations or forward guidance, whatever it is, up 50 basis points. So we're going to say, like, let's let the forward curve price a little bit higher interest rates. And we're not going to be that restrictive in things. That pushes real interest rates down. That's why we've seen 1-year real interest rates move down so much over the last year as we moved into this. And this is one of the main drivers of the credit cycle, because we're still, we're 75 bips from negative territory. 1-year real rates are likely to move lower and negative sometime this year, in my view. 2-year real rates, they're a bit more elevated, but still not restrictive enough. 5-year and 10-year and 30-year are a bit higher. But the fact that real GDP is still pretty strong, and I'll actually go to an article that we're seeing with this, is connected to this idea that growth in the underlying economy is fine. This idea that, these higher interest rates are about to cause things to collapse, not really the case when you look at the underlying data.
All right, I have a question on this because I want to try to wrap my head around it even more. Okay, so if the market is kind of pricing in more inflation, but the Fed response is we're not really going to adjust our stance here because of X, and X, then real interest rates can start to move down. And basically, it's showing that they're not restrictive enough, which is going to then push more money out the risk curve until that tension between inflation expectations and the Fed stance gets too wide to where they would be too late and wrong, to where things would start to break without them adjusting. And that's where maybe the long end starts to price in the mistake of the Fed. Am I understanding that kind of connection correctly?
Yeah, 100%. I think that is, if we look at, and this is a chart you can build on TradingView, is that when we look at the changes in inflation relative to interest rates, let's see if we can get this. United States inflation rates. There we go. Okay, I have core inflation here, but you can see that during, and we'll just go over 2021 because that's probably a pretty good comparable period of time. 2021, inflation rose and the Fed did not do anything. These are just short-end interest rates. These are not swaps, but they'll move in lockstep. This is just a 2-year interest rate. When inflation rose and interest rates didn't rise, or the Fed actively paused into inflation right here, that allowed a surplus of liquidity to flow out the risk curve, because the economy and market always pricings in real terms, not just nominal terms. And that's one of the most difficult parts of interest rates to understand, is the changes in real purchasing power for whatever nominal cash flows you're getting. So, any interest rate trader, the reason why they probably have a really good read on the economy is because they think about things in nominal and real terms, whereas most people in the economy only think in nominal terms. And so during this time, you had inflation rise, and it wasn't until the inflation risk became so extreme and the divergence was so wide that it began to impact long end rates. So you'll notice that, I'll pull this up as well, the 10-year interest rate during this time began to price the policy error that the Fed had. So notice during the period of 2021, and we even have examples more recently that I'll walk you through, notice that once inflation begins to rise right here in blue, what happens? 10-year interest rates begin to price that change in inflation, because long-end interest rates always price long-term nominal GDP and whatever. If the Fed does anything wrong, long-end interest rates always price the policy error, always. If they decide to do yield curve control or manipulate long-end interest rates, then the currency always prices the policy error, always. And so there is always a release valve for real purchasing power risk. And so the similar thing we actually saw was that during this period of time right here, inflation was coming down and the Fed began to bring interest rates down. However, notice that long end interest rates actually remained in their range and they didn't make lower lows like the 2-year did. That into core inflation remaining still above 2% and not hitting the 2% goal down here was an indication, and this actually connects to growth as well, that interest rates were not being restrictive enough, which is why 10-year is probably going to move up marginally until crude prices move back down. I mean, I have a bias to say that, I think crude prices will move back down sometime this year. We're not seeing it yet. So the stance that I have is that the longer that inflation or that crude prices remain elevated, even if there's a time lag, the higher the probability that 10-year rates move up, especially as the Fed pauses into this.
So ironically here, the market is saying, hey, like actually, even though everybody wanted to cut and the vibes were to start a cutting cycle, the market was saying, nope, not yet. In fact, if you start to guide it that way, we're going to start pricing in your mistake here.
Yeah, exactly. I think that's the main point of
that's fun, man. That's just like a fun thing, the long edge, just teaching everybody a lesson, huh?
The long end is a great teacher. I think that's one of the interesting things is, a lot of people trade short end interest rates. There's a lot of people at banks that trade those, but long end interest rates and FX are always the more difficult ones to trade. And they're always, if you ask people who are in the rate complex, I would say broadly speaking, you always have fine risk reward in SOFR or, short-term interest rates to do stuff. But it's always the long end interest rates and FX transmission that is harder to quantify, which is why if you know how to do that, you are like basically the most valuable guy at like a bank. So the other component, not only with inflation, but also, here's a Bloomberg article talking about 10-year yields, is the fact that we have a strong economy right now. And there are some things I agree with here and some things I don't, but let me walk you through this. More signs of economic and labor market strength Wednesday have 10-year yields primed to rise further as they test the midpoint of the range. Yields increased after the May ADP private sector payrolls data was above expectations at 122,000. So 122,000 jobs were added to the U.S. economy in May, or based on the May ADP payroll data for the private sector. So this is not about government spending, it's about private sector. The strongest since January. Goods producing jobs rose 8,000, while service jobs increased 114,000. And the ISM services report broke a 2-month slump, rising to the highest since February, with gauges of new orders and business activity both increasing, signaling resilient consumer demand. So just remember, when people talk about all these, by the way, like all the consumer sentiment data is like trash. Like people using that have no clue what they're doing. Consumer sentiment data, like no one uses that. Like anyone at a bank, trading risk, no one uses that at all. The changes in economic data and especially alternative data are all showing that there is not a significant contraction in growth. So people are saying, oh, well, the consumer is getting cooked right now. Again, not according to the underlying data and not according to interest rates. We are seeing jobs get added. We're seeing new orders come across. We're seeing business activity accelerate. And all these data sets right here are like 10 times better quality, 20 times, than the consumer sentiment data from Michigan. Like, the Michigan stuff is like, I don't know. It's just like taking some type of, sentiment survey that's super skewed, biased, and that doesn't impact markets at all. Which is why, if you look at any of these data points, they actually move interest rates in the data release. Whereas, does a Michigan sentiment do it? No. So just think about what is moving the market. The increase in ISM prices paid to the highest level since August 2022 will support higher yields. I actually want to pull up that chart really fast because that's a really interesting thing to note in terms of where are prices coming through right now. And let me pull this up right here. Here we go. So notice this is the ISM services, and these are business prices. So the business prices that we are seeing right now indicate that prices in the system and inflation in the system, hang on, here we go, are increasing. So you can see in the blue line right here, the survey is purple, blue is the realized. You can see us moving up pretty significantly, and we're almost at 2021 levels, which makes sense because we are seeing the credit cycle push capital not only out the equity risk curve, but also on the economic side as well. And here's what I would just say. When equity valuations are at all-time highs, and like they are right now, and the largest in history, and everyone's making money, that money flows into the economy, like by default. I mean, people call it the wealth effect. I mean, there's some other kind of transmission mechanisms that function with that. But, all of those changes all feed into the economy and increase the probability of inflation rising. So one of the things I'm forgetting the exact number. I know someone will correct me on the quote, but like SpaceX, there was like multiple billionaires made in Texas based on the SpaceX IPO, or the SpaceX IPO. If it comes out at market, around market, which it will, they will basically, like, there was like a ton of billionaires added to Texas because they invested in SpaceX. And then like hundreds of people who have like $100 million or like $20 million, $50 million, all this like crazy money because they invested like $1 million or 25K or whatever it was back in the day. So just think about it. Those people, even if they don't sell their SpaceX shares, they'll borrow against them and go spend money. And those people will go create jobs. They'll either create another company, or their actions, their consumption will begin to feed into the economy, and they haven't even sold any of their shares, right? And that's how the economy works. And so that's another kind of indication of this entire upper K, lower K kind of divide and inequality that exists right now, is that all of the top people are borrowing against their stocks to fund their consumption, because that's literally the smartest things to do, especially when the equity market just keeps melting up and the government's like, yeah, we have your back. And then you almost get paid to take out debt when real yields fall. So all of these factors all come together, and people think that, oh, well, no one would take out debt to do this, or that. And, you really think that someone who has, let's just say even a $10 million, $20 million position in SpaceX, that they want to sell those shares when the total addressable market for space is theoretically infinite? I mean, the total addressable market for space goes pretty far. There's a lot of market up there, right? So the fact that we have all of these changes taking place and that SpaceX could go to a $10 trillion market cap over the next, 5 or 10 years, do they want to sell those shares? No. But they want to be able to have some type of consumption or something like that. And so they're going to borrow against them. And even though you think that, like, a lot of low-end consumers or people think that, like, oh, there's this entire, Dave Ramsey of like, never take out debt. Like, no one who has a massive tax liability thinks like that. No one. So I think all of these things are implicit assumptions in the underlying changes. And, we have the, people are, a lot more people are shorting bonds right now. And people are, kind of trading that against the correlations they're seeing in crude and rates, because even if crude comes down a little bit, that inflation impulse still needs to feed through the system, and maybe some short positioning gets squeezed out of the 10-year, but like it's probably not going to rally as much, which is why like some people probably, you buy puts on crude for it to come down and then buy puts on the 10-year as well, especially as vol has fallen a little bit, because, or run a pair trade or something like that. So the idea is that, traders are, on watch for the convexity hedging. Some will extend. So, that's really what we are seeing in the 10-year right now. And here's actually the article I wanted to share on SpaceX, because this is one of the most misunderstood, I think, factors for markets right now with this entire SpaceX play. And this article talks about shorting SpaceX. Jefferies became the go-to bank after missing the IPO. Basically, the article says it's the kind of look that looks ambitious investment bankers usually strive to avoid. When SpaceX named roughly 24 firms handling its IPO, Jefferies was conspicuously absent. But behind the scenes, bearish investors and some Jefferies' own bosses see that as a unique opportunity. Hedge funds that aren't sold on Elon Musk's rocket to tweets empire are hitting up Jefferies to see if they can arrange bets against SpaceX shares once they go public in one of the most highly anticipated initial public offerings ever, according to people familiar with the matter, who asked not to be identified, whatever. Now, the long and short positioning in SpaceX is going to be, this connects to the entire thesis that we have about Hyperliquid. It is the most anticipated, deal, IPO, probably in history because it's the largest, but it is the most anticipated deal. All of the Elon believers are not going to sell their shares. And you have all these other people who are saying, well, maybe we can short it. Maybe we want to, have some, changes because we're not going to have a huge float or whatever it might be. There are all these different short-term factors. Then comes in Hyperliquid as the only place for people to get a real pricing mechanism of the shares as we move into this kind of dynamic between all the investment banks and the insider information that's taking place for how people are positioning around it. So, you should be watching the SpaceX USDC on Hyperliquid very closely, because it is what all of the guys on the investment bank side for SpaceX are watching very closely right now. So Jefferies, the biggest investment bank outside the listing, is now uniquely situated to arrange those trades for the short side of SpaceX. While Wall Street firms routinely help clients take positions on all sides of company shares, their lawyers can get nervous when one desk pitches a stock's prospectus to the masses while another helps clients bet against it. So you can see that there is a growing divergence taking place in markets around this. And that's not to mention how Musk, the famously, mercurial billionaire, might react if one of the 23 banks he hired for SpaceX debut helps set up big bearish bets. Banks clamor for a piece of the IPO with a record valuation of at least 1.8 trillion. Goldman Sachs chief executive David Solomon reached out to Musk personally, sliding into his DMs on Twitter. His bank and Morgan Stanley ended up listed first on the deal, which is big enough to generate 500 million in fees for underwriters, even if they accept an unusually low margin. So these types of pieces of information, and then connecting that to Hyperliquid, connecting that to things like Tesla, connecting that to, passive flows, connecting that to positioning. Those are all going to be important contexts and signals to watch, especially as it relates to interest rates, because the interest rate side is going to frame how much money is in the system to either flow into SpaceX or not. Now, the additional thing that James and I have already talked about is that how is the market, as it relates to the money in the system, beginning to digest all of these changes around AI as we move into these IPOs? And this is where Alphabet, or Google, really comes in the recent deal and capital raise that they had. These articles right here, where we talk about Alphabet's $80 billion capital raise, is very important to watch because they all function as markers along the path to say, when is the market becoming unsustainable in either the liquidity that exists in the system or the liquidity is beginning to get pulled out and the market is not able to digest these types of issuance. So Alphabet's 80 billion capital raise reflects the consequences of the 112% share surge over the past year. I mean, over the past year, one of the largest companies in the world, it rallies 112%, illustrating how such rallies in the AI stocks ultimately become self-fulfilling. So the idea of the self-fulfilling prophecy here is that the stock rallies so much because of all the AI things taking place. They're now, the higher a valuation of a stock, the easier it is for them to issue shares and not dilute shareholders. And so when they need to raise cash, it becomes easier and easier when you're in this situation. Most of the proceeds will be for capital expenditures to scale AI infrastructure and global compute. The company also plans a $40 billion at the market program that will primarily be used to facilitate an administrative change in how we manage tax obligation associated with vesting employee equity rewards, according to the statement. So the idea here is that over the last, I would say even 5-7 years, the theme of Mag 7 and software has been buy back your shares. Even take out debt to buy back your shares. Now, the earnings function of a company is so great, and the return potential on CapEx is so high that they're now issuing shares and not buying them back, which is a total reverse of what we saw in the 2010s and even in 2020 and 2021 with share buybacks. It's such a large reversal that if the market can digest it, which it is right now, if we just go to the Google chart, you'll see this. If the market can digest it, it is an indication of how strong the underlying reality is for all the AI CapEx and the risk reward around it for these companies. And so these are all markers along the road that are telling you if the road ahead is getting more dangerous or it is, we're cruising along without any warning signals. And if you look at, the announcement from this, we have, let's just go over the last year for Google stock. We have Google up 115%.
Can I ask you something real quick
Sure.
on that?
Yep.
Like, when you read that article, what's your initial gut reaction to that? Is it they know what they're doing? This is actually really bullish. They're signaling that, or are you like, oh, this is pause for concern? I could see how this could get a narrative attached to it that like they're kind of behind not seeing the plate correctly.
My initial reaction is on the fundamental side. I don't think Google is making a mistake here. I think that they recognize that they have such an opportunity on the AI CapEx side that we're still not in the late innings of all this AI CapEx stuff. People don't get it. We're not in the late innings. And I think that they are making a good bet, and they're financing that with equity issuance, which is also probably a good idea given their valuation. And they know that, okay, when we do this, the issuance it might push down the stock a little bit, but that's where understanding, these changes right here, what I think what I would do is I would say, I think that we're going to see how the market absorbs this information. And, equity markets are, a little bit down on the day today. So I'm not super worried, right? ES is down, tech is down a little bit. The Russell is down a little bit. So what I would say, what I would do actually is let's pull this up.
It's just interesting while you pull that up, because I just find like it's almost as if everybody is scratching to just try and have some sort of reason to explain where like another pullback might come from. And something
Totally.
like this, when I first see it, I'm like, ooh, this is one of those spicy things where they could be like, oh, they're all like going in. It's almost like makes me more bullish Oracle, because if you watch the Oracle video I made, it's like, yeah, Larry was a step ahead of this. Like he's almost doing what they're doing now in a way.
Totally. Yeah, he pulled all of that into the present, and I just think he's the GOAT for doing that. And people, this just or here, I'll touch on that in a second. But
Go ahead.
I
Sorry.
need to figure out really fast. This will be broadly correct. Well, I have to edit this later, and we'll talk about this. But it's not gonna work. I'm going to pull up this chart and I'll talk about it later for paid subscribers. But what I would do is I would look at how much of the fundamental attribution for Google exists here. So, for example, if we begin to see Google underperform the tech sector, then that is going to be a signal that there's actually fundamentals getting priced to the downside because of their issuance. But what I would be watching for is as we move through this period of time right here and in this box, if we can have all that equity issuance go through and we don't underperform the S&P 500, then it shows you that the equity market is digesting everything and it views Google as they will provide higher returns in spite of the short-term equity dilution. This is kind of like the whole idea of PER and other things, right? Like you can have, if Google issues shares, that dilutes shareholders, like it does, right? Like that's not a secret or a bad thing. If it uses that money to then create a higher return for shareholders that outpaces the dilution that takes place, then you will have a stock rally on dilution. You'll have a stock outperform on that initial dilution. Maybe the positioning and market microstructure kind of absorbs the imbalance, but overall, like, again, you can't think about things so deterministically, because when you have these changes, if the return on investment is so much higher than the dilution that takes place, Google will just hit the bid super hard. They will just rally so aggressively. And that's why you want to connect it to the attribution analysis here. So when I read this article, I don't think, oh, this is really bad. I think, okay, what levels is this taking place at? How is the market absorbing this risk? Is Google outperforming or underperforming? And then are these CapEx returns about to come into play? Because if they are, then you are going to have Google really rip, and the people who thought the dilution was bearish are going to get squeezed out hard and be forced to buy back in. So when you see, and again, I think this is going to be even more similar, but Alphabet in its most recent proxy statement said that it issued the equivalent of more than 281 million shares in equity compensation to its employees that has been issued and not yet vested. We are going to see like pretty insane compensation packages for everyone in this world, because think about over the last 10 years, how everyone gets mad because CEOs get paid so much money in equity compensation. Like that exact thing is going to happen with employees now, because you have employees that are getting paid hundreds of millions of dollars a year because they're the AI whizzes, and they actually create billions of dollars of value just alone on their own. And so you have to pay them hundreds of millions of dollars. And so you are going to see that more and more, and people are going to get pissed off because they're like, that can't be fair that a single person makes that amount of money. And, guarantee if you were in that situation, you would think it's fair, but the idea is that we're going to continue to see that return on investment that I think is going to be really important to watch. So when I see that, I just think that they're investing. It would be the same thing where I would say, if you take out debt at a HELOC or an equity loan or whatever it might be, and you say, well, is that a good decision? Well, I would just say, well, what are you investing it in? And is that paying out? Because it's more dependent on that. And then where do the levels sit for that? And how does that connect to this attribution analysis model that we've laid out for subscribers?
Well, could you just real quick, I'm changing the attribution model on mine over for Google. What were the sector ETF and subsector.
I know that's what I was trying
Yeah.
to pull up.
I was like, oh shoot, I should have seen it.
The sector is obviously like XLK, but the thing is, I don't know if there's a subsector ETF for it. That's why I'm trying to figure it out.
Oh, okay.
I know there is, because there's let me see.
I could ask chat. See if ChatGPT has it real quick. It says XLC. The main sector ETF for Google is XLC, the communication sector.
Yes. Let's see if we can figure this out really fast. XLC. I just need I'm trying to find the subsector one. So let me get that. I have to, you basically have to just take out the subsector one and
Could you just make it both XLC or something?
no, it doesn't work like that. That's why I have to like go, I just have to recode it really fast. I'm doing it right now.
Okay. Coding on the spot, guys.
You know how we do. But you can kind of see how this idea of like, this is why like people look at news and they're like, oh, is this bullish or bearish? Whereas I look at this news and I just think, what's the attribution analysis? How does this connect to the risk reward? How does that connect to the levels we're at? Like that stuff is like so obvious to me, you know?
While you're doing that, I'm going to just bring up real quick. One second. So let's see if I could get it. You guys can see the Oracle situation here where as it peaked back in September of last year, you had the attribution model start to roll over from like sector flows, subsector flows, fundamentals. And it makes sense as to why it got absolutely crushed. But once we go back over, once we get the Google one situated, you might be able to see a similar kind of movement there. And I'm just wondering if we'll see that broadly across others if they start to make the same moves.
Yeah, what I would say is that I think the communications sector, the XLC, it doesn't have the same subsector ETF, so we're not going to see the subsector. But broadly speaking, on the Oracle chart that you have up, this is always where like you quantify how you stack edges. Like it's not complicated to quantify those things, right? Because then you don't misdiagnose what's happening, and you're like, why is the correlation changing? Why is it doing this? Why is it doing that? And this goes back to like why we were stacking all these edges and saying like how do we do whatever it might be, you know?
Mm-hmm.
While I have it coding it up right now, let me share this final thing right here on how do these factors that we're talking about connect to the broader market. And yesterday, we had more than 8% of the S&P 500 rally, at least 5%, which is the sort of thing one might expect during market-wide short covering, like after we saw after the Tarrant tantrum in April. Not a day when the market goes down a little or up a little and then closes positive. Basically, the idea is that there's a rising number of stocks that rally a ton when the index goes nowhere. So this is when the index doesn't move at all, but there's a ton of stocks in the index that rally a lot. That shows that we are having more dispersion and fundamental pricing in the underlying index as opposed to a broad macro rally, which is why rates have kind of been in their range. FX is compressing. When those are happening, you're unlikely to see this very pervasive rally. But that's when you want to look for things like this, where certain stocks are rallying a ton, and you want to look and say, why is that happening? How does that connect to the bigger picture? So this chart visualizes that dynamic of dispersion, and a lot of people connect it to short covering, or when people are adjusting their equity books. All right, let's see if we can get this. Here we go. All right. And
real quick, guys, and Alfie just mentioned this. What you just mentioned about the dispersion in the S&P 500 is in the playbook in the primer section. So if you guys go to capitalflowsresearch.com, the main part of it, just like the main picture there, click on the free primer section, scroll down to the S&P 500 primer, and just get that PDF and read through it. I also made a thread on X about it.
Cool.
But I would suggest doing that.
I like it. All right. So you can see right here. Here's the indicator. James, if you want this, I'll.
That's proprietary. Just kidding.
Yeah. That's the problem. I keep sharing too much stuff that's too proprietary. I've had people say like, dude, stop sharing so much code with people. We're losing our job. And I'm just like, whatever, man. Get a better job. It sounds like you have a claudable skill. So the change here in equity price action. So we pulled out subsector because we don't have a subsector ETF for the communication sector. But you can see here the broad market and fundamentals were the main reason Google was rallying. But the subsector was actually contributing negative returns. So this is really important because I would say the broad market is still, holding up positively, and we could even go to a shorter time horizon and look at this even closer, right? But like, you have the broad market. You have the broad market as a positive attribution and fundamentals as a positive attribution. And now, more recently, we've had sector flows and fundamentals as the primary reason that Google has moved down from these highs right here. And it's interesting because you can see right here, notice that this high right here in Google, you didn't have it overlap with fundamentals. Fundamentals were actually negative during that time. So it means that it was driven up by the broad market and the sector, not the actual Google company itself. So this move right here, I would say, is partially driven by the sector. A lot of it, I would say, is sector, and then partially by fundamentals. And what I'm watching is, do the fundamentals flip to a positive attribution as we move through these changes in the issuance for Google? If it does in the market, even if we move down, so you can see here, like the broad market flows are positive, but then the fundamentals are negative. If we move positive in the fundamentals, even if it sells off a little bit more because the S&P pulls back a little bit or sector flows pull back a little bit, that will tell you that the market is adjusting well to the Google issuance, likely, if that's the main factor that's going, which is likely. And that would be positive overall for how the market is adjusting to that, which is why, one of the things that I watch the most is how are fundamentals getting priced overall with these changes. And let me see if I can pull this up. So if we look at communications, this is why I'm always looking at sector flows and saying how much of each of these are driven by fundamentals versus communication, or versus the sector versus the market and things like that. And, you can see Meta has a higher fundamental attribution than Google. And I would say, okay, why is that happening? Netflix has a higher fundamental attribution than Meta or Google. I would want to say, okay, how is that? Why is that happening? And how is that getting priced into the market? A lot of that Netflix has to do with some of these things about the bids for, their investments into, it was Paramount or something like that. Some other acquisition they were trying to have. So, especially as it relates to the tech sector, how are the fundamentals getting priced? So, for example, here's SN, SanDisk, and you can see that basically all of the changes that have taken place are all fundamentals. So if we look over the last 5 years, and let's pull this little one, you can see that fundamentals are basically the largest attribution for it. And you can see that 70% of the attribution for SanDisk has been fundamentals, which makes sense because they're just melting up to the right and they're outperforming everyone else. And that there's a reason for that. It's because they're fundamentals, not just because of the stock, or not just because of the sector. So same thing for all of these other names. I want to look and be like, oh, why does Apple have a more fundamental attribution as it's rallying relative to the rest of the names in the sector? Why is that taking place? Why is this primarily sector flows as opposed to something else? So these are all things that I'm watching every single day, and those are the things that you want to be thinking about. And that is what connects to this whole dispersion change and what that means. So that's what I would kind of frame for the equity side. All right.
I'm a Pine noob, so I'm trying to input it now.
Amateur hour over here. Let me see if I can just copy and paste the code into.
Well, it's because your message included your name, so it's like you got to remove some of that. I'm working on it. That's cool. We're in the weeds today, boys.
Or do you know what I should do? Is just here, James. You can just take this link instead and open it in your trading view.
I got it.
Okay.
I got it. Yeah. Still puts the subsector thing in there for me.
If you just open that link, you can copy and paste the indicator over.
All right. Okay, got it. Nice. Second time around, if you're just showing up, we were talking about how the Google announcement yesterday that they were issuing more shares to raise, I think it was $60 billion.
Yep.
Also timing wise, they have been doing it pretty well. So you could take that for what you will. We're trying to just kind of talk through the flows and the attribution in regards to Google and other companies. So for your comment there, that's kind of what we're working through here.
Nice. Let's jam through some questions, and then I laid out some notes for paid subscribers in the chat, and I'm going to be sharing more on the website just for paid subscribers on some of my views that I won't cover in here. But I'd love to jam through some questions and talk more about what people want to dig into.
Sure, I'll pull some up for you that I've starred. So, do you feel like Microsoft and Oracle move in near lockstep?
Yes, well, because they're in the same subsector and kind of section. I would be long, I think being long Microsoft and like Meta calls sounds like a great option here. But yeah, I think Microsoft is going to hit an all-time high. Microsoft is part of the IGV ETF as well, right? So the subsector of software. So it's expected that they're moving in similar lockstep. Oracle has more upside in my view because of what Larry Ellison is doing relative to Microsoft. Microsoft is not taking as much risk, even though they're bigger. So that's what I would say.
Okay, Alfie, friend of the channel. So the chain is rates and FX is, I guess, more important than equities or leads to equities. And I know we can't attribute returns in rates with equities, but surely you could attribute FX returns from equities to a degree. How do you think about that?
Just shoot me a text, man. I'll cover that with you offline. I think that would be a little bit more complicated for people, but let's definitely shoot me a text, man. We'll talk.
The debt issuance from hyperscalers is also pretty inelastic given the urgency in building out data centers to be first to AI. Thus, higher interest rates and hikes may have less impact on growth.
I wouldn't say that there's less, or it's more inelastic. I mean, I think it's getting absorbed by the market pretty aggressively, but I think a lot of it has to do with that credit spreads are so low, so that when credit spreads are this low, it just even if interest rates go up and credit spreads don't rise, they're not paying as large of a spread, even if interest rates tick up a little bit. So I think the market's absorbing it. I don't think it's because of inelasticity. I think it's just because there is money in the system.
Why is the Fed not being restrictive in the current macro environment?
Main idea is 1, real growth remains positive. 2, capital continues to move out the risk curve. So for example, if you go to the report that I just wrote on the gamma squeeze, I had a chart in here on the Goldman Sachs non-profitable tech index, the most rolling short index. When capital is moving out the risk curve this aggressively and real rates are falling the way that they are, where clearly inflation risk has risen and the Fed has inflation risk has risen by like 100 or 200 bips, and they've only pushed up rates by 40 to terminal. So we're not restrictive enough. Equity markets are still just rallying really aggressively. Inflation swaps are not falling, and capital is moving out the risk curve in all these risky sectors. And that's why we have so many of the meme stocks bidding so aggressively right now. And on top of all of that, that's why the gamma squeeze and PER environmentally is actually a high probability in my view. So again, that's why it's another page in the book, another edge to stack for why this is taking place and why I think it's a high probability.
So along that note, how big do you think the lag is between the US 10-year reacting to the policy error, or it could be vice versa?
Yeah, I don't really think about you can never measure lags. Lead and lags are never the same, and you have to really get a clear view on the strength of the impulse that's taking place. So what I would say is we don't, how much is the lag really depends on how long it takes for inflation to make its way through the system and come back down. And we don't really know the answer to that yet. All we know is directionally in rates that probably don't want to be long bonds yet. There will be a moment to get long bonds, which when it comes, I'll be sharing it for paid subscribers, because I think that once you have any type of contraction in liquidity, you're going to have a mega bid in bonds. And I don't know if that's this year, next year, or whatever it might be. It's probably going to overlap with the carry trade unwinding a bit. And we'll see how that plays out with cross-border flows in gold. But what I would say is that there's still risk. We still need to see the 10-year digest all of the news and all of the impulse. And then we need to see the impulse flip to lower crude prices, a little bit weaker growth, the Fed fall behind, the curve flattening, all of those things kind of move in lockstep. And maybe we drag on cyclical sectors in the equity sector, or in equities. we see some of the higher risk names begin to drag a little bit, then you begin to say, okay, now things are stacking a little bit more to get long bonds. That's what I would say.
Oops, sorry, I was muted. You obviously follow a massive amount of macro variables. If you had to rank the top 3 most important to tell us which regime you're in, that's easy. Just pick the top 3 and you'll know it all. What would you pick?
I think short end interest rates and long end interest rates and the SOFR curve. If you can understand those 3 things, I guess it's kind of 2, but if you can understand short end interest rates as reflected by SOFR and long end rates, and the curve between them, so that's 3, like the yield curve regime. If you can understand those 3 things, which again, there's an entire interest rate primer on this. If you go to the main page, educational primer section, exactly what you want to do is go to the interest rate primer right here, read every single thing in there, and you're like, what's the top 3 things? It is short end rates, long end rates, and the curve. If you read all of these books, then you'll understand all 3 of those things, and you'll be good to go. I think that's what you should do.
Okay, a couple more questions. I can understand the melt up from the end of March, real rates going down on the 5 and 10-year yields. Looking at Fred, both real rates are now higher than March highs. So are real rates still driving us up?
What I would say is this is twofold, and I would go back to the credit cycle reports that I wrote that you can find linked right here. So go to Gamma Squeeze article in May 30th. You should share this on Twitter with all your friends. You should tag me. But on the credit cycle, go through these reports. I would say this is twofold. Number one is the AI side is clearly retooling things. So there's a fundamental driver in the credit cycle melt up right now. Number 2 is that short end real rates are still very accommodative. And that is allowing a lot of capital in the carry trade and a lot of other things to remain create a surplus of liquidity in the market. So I'd say a lot of it has to do with short end rates, and the long end rates are really not dragging on cyclical sectors yet. So we're not seeing even long end rates be restrictive enough. So that's what I would say about that is, yes, we moved up. However, think about it like this. Imagine you locked in a short-term interest rates, a low interest rate on your house during 2020 for time into the future, for perpetuity, for 30 years. You basically have that locked in lower interest rate of cheap money. Just think about like when there's a liquidity impulse, every single corporation and hedge fund go and aggressively get leverage right away, and they lock it in. And so that's why you can have these impulses last for a while, even if interest rates rise, because people locked in cheap leverage in nominal and real terms. So that's why you have these elements where you're saying, okay, well, interest rates have come back up. Why haven't we mean reverted the entire move? Well, same reason why you got a house at a low mortgage rate, locked it in, and now you have more purchasing power because your income has risen, right? That's why we have inflation risk increasing and not just going right back down as interest rates go back up, right? There's lead and lags, there's balance sheet kind of mismatches, and there's all of these things that happen. And everyone is very smart and they're trying to get an edge, right? And so these are all the factors that take place. That's what I would say.
Okay. For risk, is it equal to the size of your position, what you expect the volatility to be, the liquidity and slippage of your positioning, with a surprise factor and a correlation shock? Would you agree that that is how you would define risk?
I think I'm not going to get too like nailed down into like a specific metric of like, because like everyone's going to argue about like, well, this is risk, this is alpha, this is beta. It's like, well, let me tell you something. The guy who makes, tons of money without losing a lot, like probably understands how he's taking risk, right? But what I think is that you need to know all those things that you noted for taking risk. But even if you know all those things, you could still lose money, right? So that I think that you want to know all those things on a portfolio perspective. We don't talk a lot about like portfolio metrics or risk metrics or stuff like that, honestly, because if you just go into ChatGPT or any book or risk management. There's risk management primers on the Substack. We just go through those. Like they're all pretty simple. Like hit ratio, risk reward, frequency. Like this is not rocket science, right? Like at the end of the day, like risk management math is like second grade math. And especially if you're not running high frequency trades or really highly quantitative trades, like risk management math is like second grade math. So it's like not rocket science. The bigger problem is like the ideas and thesis and your ability to execute on them well. That's what I would say. I mean, look at James. Like he doesn't know math beyond the second grade level. And
I'm wearing a Mickey Mouse hat. That's Mickey Mouse math. That's what it represents.
So I don't think I haven't really taken any math. I don't have an advanced degree in math or anything like that. So I'm not that bright.
I think what you're really good at, and I've been better at after hanging out with you, is like we just try to ask good questions. And if we could kind of find the answers to good questions, I feel like it helps so much more than trying to box yourself into this framework. And I think that's like where, a lot of the people I talk to from my channel and stuff, they're always trying to like, again, we go back to that suppression of volatility. How could I box out volatility so that I could just like operate in this little perfect world? And if you want to like outperform in this like savage environment that is trading, like you got to like let those box edges go. There's no box, right? You got to find out how to operate within that like enigma, that dynamic, moving, amorphous thing that is the markets around the globe. So I think given that, like you have to accept the chaos and figure out some sort of scaffolding for yourself within that. And it's just hard to define your risk on every metric. So something to think about. Last question here. Is the per hype divergence today structure to per being a DAT?
I don't know what that means exactly, but I'll talk about the divergence today.
I think he's probably trying to take one day and understand why is per down today when Hyperliquid is up, and you need to have the perfect answer.
Yeah, I think it's because they're issuing shares when we're at a premium, and I think the issuing at market is because they're building a larger position in hype. So I think that they probably the other day when per was up and hype was down, they probably issued a ton of shares at the money, bought more hype, and created more shareholder value. And we're in a lag right now between when that gets published on the website. So that would be my suspicion, my guess. I don't have insider information on per, right? I don't know anything that you guys don't know, So what I would say is continue to watch how these changes take place. I wouldn't be surprised if on a day like today they bought back shares, right? I would not be surprised if they do that because they have shown a consistent pattern of creating shareholder value, especially on a high frequency time frame, on an intraday and intra-week basis. So, these are all things that you want to contextualize. Every single time we see per down and hype up on a day, everyone comes into my comment section and like says something about it. And then anytime the opposite happens, no one cares. So it's fine. It's how the game works. Yeah. I'm here to hold risk. James is here to hold your hand. And, I think it'll all kind of work out.
I agree. I just think, guys, if you're trading per, and you're new to, you don't even know what Hyperliquid is, like go back through all the things Capital Flows has put out on, like literally go copy the links. If you don't want to read it, copy the links, put it into Claude, have it create a master thesis for you, have it come up with all the things you should be watching. I mean, I bet most of you out there don't even have Hyperscan saved as a bookmark, right? If you go to Hyperscan right now, the next 24 hours, there's $20 million of TWAP hype buy pressure. Now, does that mean hype has to go up? No, but it's giving you an idea of the demand that is just currently in the ecosystem. And then if you understand how the DAT works, how they issue shares, go back and see what moves they've made before. Is it accretive? Is it not? Who are the people running the DAT? Understand that. The broader pullback across the board today, like you can start to develop this grandiose idea of what's being played here. Paint the picture, and then figure out when you started painting and when I started painting. It's going to be different points. So we should be acting maybe in a general, same schematic overlord here, but like we're all going to have kind of entered and exited at different ways. And, think about all that.
Money. Well, James, final thoughts as we're moving into the rest of this week. We'll have live stream tomorrow, 8:30 a.m. Mountain Standard Time. We'll be covering more on equity flows and some changes in interest rates as well. We're going to want to connect some more ideas for everyone. I'll be laying out a report tonight. And I hope that the takeaway for everyone is the macro regime and understanding it is going to be very critical regardless of what you're trading. And James, what would you just kind of challenge and encourage people to think about as you have the importance of knowing the big picture, connecting it to your situation, and just taking agency over that? And like that's actually, taking a bet on yourself by connecting the macro to your situation is like one of the most powerful things you can do.
Yeah, I mean, this right here, follow up to the guy's question, it will work out. It's my largest position. Like the fact that, all right, I gotta, like, this is tough love for you, man. I'm glad you're doing okay. It's your largest position. But like, if you're coming into this stream and you're asking, why is per down today and hype is up, and then you're saying it's your largest position, you have too much size on, man, and you're gonna make a massive blunder. You're going to fuck this up. That's like all I have to say about that. It's too much. If you don't understand the thesis here underlying to a great extent, it should not be your largest position. Could it be a good return that you could rebalance into and out of at some point? Sure. But like, you need to be operating from a distance to this position. And if you're not, like, you should be right at that. We try to go right up to the line where we lose clarity, right? You don't ever want to step into that space where you get lost in the sauce and you just become reactive to the market's pressures. And you want to not be so small sized that like you just literally don't care. You need to be riding that line. And that's what we're trying to find the way to best understand the most understandable thing in the world, and then ride the line of risk right up to the edge to where we could extract the most of it, where people aren't willing to take that step and take that risk. I mean, that's kind of what we're doing here. So just keep working towards doing that. I get uncomfortable. Flows gets uncomfortable, even though he doesn't want to admit it. But think about it. If you're a 4-foot frog operating in this world, like, you're going to feel like people are going to step on you, and you got to figure out how to navigate through the crowds, right? You're not always going to have a shoulder of a giant to step on like me. So hope that helps.
It is 4'2" frog. I am 4'2".
Mm-hmm.
But
you have those froggy platforms on.
Yeah. just
and,
so
by the way, guys, we are working on like improving the stream and making more collections, and I think you'll be seeing some changes at some point soon. But for now, just show up every day. This stuff is super valuable, and just like imagine, I mean, we talk about it all the time. 2-3 years from now, we won't be talking about per, Hyperliquid, or whatever. We'll have some other big uncomfortable bet on that we also have to talk through for months, right? So I think it's such a cool journey, and might as well keep with it.
Perfect. Awesome. All right. Well, everyone, thank you for joining today. I'll have, if you're a paid subscriber, read the notes that I put in the chat this morning. Those are important. And then I'll have a report later tonight exclusively for paid subscribers on the Substack, laying out some more proprietary models and research that I have that I want to talk through. So with that, I will catch you guys tomorrow on the live stream.